All right, welcome back everybody. I know I assigned some homework in regards to transaction analysis. Just to repeat a few things that I said last lecture, transaction analysis is that first skill I want to make sure that you guys master. All right? So as we go through these, I want you to be responsible and start being able to ask yourself, do I really understand this? With accounting, if at any point you realize, I don't know what he's doing, I don't know how to do this, that's when you need to come into office hours, come into tutoring. Folks at home, email me. You can come into tutoring as well, okay? And but I want to make sure that you don't just let that go on, okay? You don't want to procrastinate with accounting, okay? Because everything builds on each other, all right? I kind of gave you some, but I gave them to you in a little different order, didn't I? I kind of gave you my own unique order. What was the first one I gave you? 112? Exercise 112. Well, then let's do exercise 112, okay? Okay, exercise 112. Zelda began a new consulting firm on January the 5th. The accounting equation showed the following balances after each of the company's first 5 transactions. Analyze the accounting equation for each transaction to describe each of the 5 transactions. So this is a little similar to the one that we did in class the other day, isn't it? The only difference here is now you got to kind of look at the balances and see what the change was. It's not telling you the change, it's actually telling you what the balance is. Okay? Now the first one, transaction A, this is the very first transaction of the business, isn't it? So everything was 0 before that. Now cash is $20,000, Zelda capital is $20,000. So obviously what happened here?
$20,000 in the business.
That's right. Zelda invested $20,000 of her personal money into the business. Very good. That's A. In B, we see that cash went down by $1,000, office supplies went up by $1,500, and accounts payable went up by $500. Okay? What happened there? Looks like she bought some office supplies. She bought $1,500 worth of office supplies by paying $1,000 cash and the remainder putting on account or on credit. So there's now a $500 account payable. Correct? Good. C, cash went down by $8,000 and let's see, office furniture went up by $8,000. Looks like she used $8,000 cash to buy some furniture for her office. Is that correct? D, let's see what changed. Accounts receivable went up by $3,000 and revenues went up by $3,000. Looks like she provided services to a client on credit and they will pay her later. So she has an account receivable. Okay? She will receive money in the future. Okay? And then lastly, it looks like cash went up by $1,500. Oh, by $500, I'm sorry. On transaction E, cash went up by $500 and revenues went up by $500. So it looks like she provided services to a client and they paid her $500 cash right there for the entire $500 amount worth of services. Agreed? Cool. All right, any questions on that one? Okay. What was the next one that I signed? 110. Okay, good. Exercise 110. Provide an example of each transaction that describes the detailed effects for the separate cases. Now, some of these have more than one. Okay? So, transaction A increases an asset and decreases an asset. What do you guys think? There's more than one answer.
Supplies or furniture for cash.
Okay, a couple of examples that you gave me, very good. You purchase supplies using cash, or you purchase equipment using cash. Okay, very good. Equipment or supplies would go up. Those are assets. Cash, which is an asset, goes down. Okay, any others? How about the collection of an accounts receivable? Okay. Let's say we had an accounts receivable for $500 and they paid us cash. Well, the receivable would go down, that's an asset. What would go up? Cash, that's an asset, right? One asset went down, one asset went up. Okay, so that's another example. All right, good. Exercise 110, B, decreases an asset and decreases a liability. What do you think?
Paid a bill.
Okay, paid something, like paid in accounts payable? Okay, good. Paid something that was already on the books as a payable, right? So the accounts payable went down and cash went down. Any other examples? Paying a note payable, right? Okay. Really paying any sort of payable. Paying taxes payable, salaries payable, any sort of liability. The liability decreases, the cash, which is an asset, decreases. Cool? D, increases an asset and increases a liability. What do you think?
Did we do C?
Skip
already?
C.
Did I skip C? Sorry. Okay, let's go back to C. C, decreases a liability and increases a liability. This is kind of a weird one. You thought he was going to try to skip that one and get out of it, right? Decreases a liability and increases a liability. Okay, what do you think?
I put took out a loan to pay off a bill.
Okay, and that sounds kind of weird, doesn't it? But let's say a company had taxes payable, right? The IRS started banging on their door saying, you owe us taxes. We have a taxes payable on the books. Well, we don't have the cash right now, so we go to our friendly bank and we get a loan so we can pay our taxes. So taxes payable, which is a liability, goes down. Notes payable, which is also a liability, goes up. Okay? I'll give you another example. Give you a couple of other examples. My wife and I, we just refinanced our home. Okay? We're actually going through the process right now. So we have a mortgage payable at a certain interest rate, and we're going to pay that one off with a new mortgage payable. Why would we do that?
Get a lower interest.
Lower interest rate. Okay? I think we're moving from like 4.25. We're getting rid of that mortgage, and we're going to 3 5/8. 3 5/8 for a mortgage. That's unbelievable. Okay? So our old mortgage payable is going down. Our new mortgage payable is going up. The advantage is decreased interest. Okay? Now companies can have a mortgage payable as well, can't they? They could have a mortgage payable on their office building, okay, or on a big piece of equipment. That wouldn't be a mortgage, but okay, you see what I'm saying? One more example. One more example. Let's say my company has an accounts payable for $2,000 to a vendor. We have an accounts payable, it's a liability, for $2,000 to a vendor. Well, let's say we're having a little bit of a cash crunch right now. So I go to that vendor, and we've worked with that vendor for a long time, and I said, hey, we are having cash troubles. I know we have an accounts payable to you. I know we owe you this money for $2,000, but, you know, is there some way we can set up a payment plan or something? Well, usually vendors are very happy if you go to them with, has anybody here ever done collections? No? Pray that you never have to, okay? It's not fun. But when people owe you money, if they're having trouble paying you, but they come to you and they want to set up a payment plan, most people are pretty nice about that, okay? So our vendor might say, well, thank you for doing that. Here's what we'll do. Let's get rid of your accounts payable and let's set up a note payable, okay? And they might have us sign something. And let's say, let's have you pay it off over time, you know, about a couple $100s a month, maybe for, you know, 10, 11 months, something like that, okay? And we're going to go ahead and charge you interest, a little bit of interest, 4%, okay? And since it's going to be paid off over the next year, you know, we go ahead and sign the note so that they feel a little bit better, okay? So you don't have a real old, on their books, a receivable, okay? You see what I'm saying? So we got rid of our account payable and we set up a note payable with our vendor, all right? So that's another example, okay? Good. Any others? All right, now let's go to D. Increases an asset and increases a liability. What do you think?
Office supplies increase and accounts payable increase.
Okay, good. Good, Kara. Is it Kara? Okay, good. I'm getting better with names. All right. We buy office supplies on credit. Office supplies, which is an asset, goes up. Accounts payable goes up, right? What other ones? There's some other ones too. How about getting a loan? Getting a loan from a bank? Cash goes up, notes payable goes up, right? It's an asset, that's a liability, okay? And actually buying anything on credit, right? Furniture on credit or whatever, okay? Good. E, decreases an asset and decreases equity. Decreases an asset and decreases equity. What do you think? There's a few on here too.
Withdrawing from the company.
Okay. Withdrawing perhaps cash from a company, right? Okay. Withdrawals goes up, but equity goes down, doesn't it? From our quiz that we had like the second lecture, second or third, right? The owner withdraws cash, so cash, which is an asset, goes down. And withdrawals is one of those things that decreases equity. Very good. Any other examples for this? Another one would be paying an expense with cash. Okay? Let's say I pay rent expense for the month. Well, rent expense, isn't expense one of those things that decreases equity? Okay? So I pay rent expense, equity goes down, and the cash I use to pay that rent expense also decreases, right? So that would be another example. Okay? All right. F? Increases a liability and decreases equity. You know, I don't really want to concentrate on that one too much because that's kind of a chapter 3. Kind of a chapter 3 question. And we aren't in chapter 3, are we? Okay. Curiously, did anybody come up with anything?
I took out a loan and took cash for their own personal use.
Took out a loan. It's not bad. It's not bad. Okay. Not a bad one. The only thing is that probably would be two separate transactions, you know, cash in, cash out. What this is, and I know I have to tell you, it'll bother you for the rest of your life, is this would be like if we were, and this happens quite a bit actually, you receive a bill, you receive a bill, and so you put it on the books as a liability. You're not going to pay it right now, and you put the expense on your books. It's called accruing an expense. Okay? So don't really worry about that one. I mean, really, don't worry about it for now. When you're studying for your test, don't sweat that one. You could almost ignore it. Okay? That'll be chapter 3. And G, increases an asset and increases equity. What do you think? Couple there too.
Just cash into the,
You're right, but be more specific.
like, receiving payment for a service or something also increases revenue?
Okay, increases an asset and increases equity. So, very good. You perform a service for a customer, and think about it. Revenue goes up, so equity goes up, right? If they pay you in cash, your asset cash goes up. If we perform this on credit, our accounts receivable goes up, which is also an asset, isn't it? So really performing services for a client, either way, whether they pay us cash right then or if we book it as a receivable, either way an asset increases and equity increases. Okay? Good. There's one other one.
I put owner bought something with their own money.
Something with their own money. I have to think through that one. Let's see, an owner bought something with their own money. I'd have to think through that one. That's not the one I was thinking of, okay? But I'd have to think through that one. You mean, and then they're going to get reimbursed by the company or something like that? Okay. That may not be, I'm not going to go down that road just yet. We'll get there, okay? And what concept does that kind of violate? Do you remember us talking about, we haven't talked about the business entity, or have we? Okay. We're going to talk about the business entity concept soon. What the business entity concept is if I have a landscaping business, I want to keep my landscaping business, the checkbook, the records, and everything separate from my personal life. Okay? When I go into a client, when they do something like that, Anna, is it Anna?
Yeah.
Oh, I'm getting better, okay? when they do something like that, I'm like, please, don't make it a habit. And you can reimburse yourself, but please don't be using your personal checkbook to buy stuff for the company. Or worse yet, don't be using the company checkbook to pay your daycare bill or whatever. Let's keep those things separately, business entity. Marlon.
How is that different from making a personal withdrawal from the company?
Well, but see, it's a good question. How is that different from a withdrawal? And that's what we end up treating it as. But what I tell my clients is take the money out of the company, book it to withdrawals, and then once you have that money in your personal life, then pay the daycare bill. Okay? Yeah. But when you just write a check from the company checkbook to the daycare, then you've really got to set up in your accounting system your daycare as a vendor, and it's just, right? You don't want to do it too much. Or if a company has if an owner has two businesses, keep those businesses separately. You just want to keep everything as neat as you can. Not so much just because you're anal retentive, but because a big part of accounting is that somebody can go in and understand what you've done. Okay? Understand what you've done. All right? Good. Oh, the other one was, for this one is, the one I was trying to get to, Anna, was an owner invests personal money into the company. Right? Owner invests cash into the company, cash goes up, and what else goes up? Equity goes up from our quiz, right? Okay, good? All right. Let's go to, what's next? Exercise 111? Okay, now this is really, this is where the rubber hits the road as far as do we know how to analyze these transactions? Okay, do we know how to analyze these transactions? And I want you to become adept at this. Okay, if we don't know how to do this, if you're totally confused, then again, we need to get together or get to office hours or whatever, because this is a crucial part of accounting, okay? Okay, now I hope you used your work papers. I think I showed you your work papers last class, okay? But let's go to exercise 111. Lena Gold began a professional practice on June 1 and plans to prepare financial statements at the end of each month. During June, Gold, the owner, completed these transactions. Okay? Owner invested $50,000 cash in the company along with equipment that had a $10,000 market value. Okay, the first thing you want to ask is what accounts were affected? And then the next question is, did those accounts increase or decrease? By how much? Okay? In this situation, cash went up by $50,000, equipment went up by $10,000, and this is one of those things that increases capital or equity, isn't it? It went up by $60,000. Transaction B, the company paid $1,600 cash for rent of office space for the month. Now I want to change this a little bit, but what happened is cash went down, right? Now I don't really like the way that they show this. I'm going to zoom in. I really wish they would have said expenses went up, because that's what they did. Expenses went up, right? Now this minus sign is indicating that, yes, eventually we're going to subtract expenses when calculating equity. But expenses did not decrease. Expenses increased. Does that make sense? All right. Now what they do after each transaction, and it gets a little tiresome, so if you didn't do it, that's okay, is then they recalculated the balances. And the main reason they did that is because they want to hammer home the idea that assets always equals liabilities plus owner's equity. At any point, we can figure out the balances, figure up our total assets. In this case, our total assets is what? $58,400 when I add those two together. And is that capital minus $1,600 expenses? That's $58,400 too, isn't it? Right? There's no liabilities yet, right? So at any point, we can do that. Transaction C, the company purchased $12,000 of additional equipment on credit. So what is affected? Well, equipment goes up and accounts payable goes up. And then we figure out our new balances, right? Okay, any questions on transactions A through C? please don't hesitate to ask. If you've got the question, I guarantee you there's other people do, especially at home. Okay? Okay, transaction D. The company completed work for a client and immediately collected the $2,000 as earned. Cash goes up and revenues go up by $2,000, right? Okay? Cash goes up and revenues goes up by $2,000. Anybody have a question? They got something different and they want to know why it's not true? Or you can tell me your wrong answer and I'll just shoot it down right there in front of everyone on television, okay? No, I'm kidding. Not really. Okay, cash goes up by $2,000, revenues goes up by $2,000. E, the company completed work for a client and sent a bill for $7,000 to be received within 30 days. Okay, our revenues go up, right? Our revenues go up because this is the revenue recognition principle. Even though we haven't been paid, we recognize this as revenue because we've completed the service. The service has been delivered to the customer. And accounts receivable goes up. That's another asset. Figure our balances. Everything is good. Okay, transaction F. The company purchased additional equipment for $8,000 cash. Cash goes down by $8,000. Equipment goes up by $8,000. Right? Does that make sense? See if I can get that a little larger. Okay, I know this one's kind of hard to see the answers. Okay, they refigure the balances. Every assets still equal liabilities plus owner's equity. Okay, transaction G. The company paid an assistant $2,400 cash as wages for the month. Cash goes down. Once again, I'm going to add this little plus sign here. Because your expenses actually go up, don't they? Yes, those will be subtracted. Yes, those will be subtracted when we figure out total equity, but your expenses go up, don't they? Okay? Refigure the new balances. Here's what we got. H. The company collected $5,000 cash as partial payment for the amount owed by the client in transaction E. So what happens here? Revenue's not affected at all. All that happens is cash goes up by $5,000 and our receivable goes down by $5,000, right? Everything still hold? Yes. Transaction I, the company paid $12,000 cash to settle the liability created in transaction C. Well, our cash goes down by $12,000, as does our accounts payable by $12,000, right? Okay, good. Everything still holds, right? Counting equation is still valid. And lastly, the owner withdrew $500 cash from the company for personal use. What is affected there? Cash goes down by $500. This is kind of like that other situation. Our withdrawals actually goes up, but withdrawals will be subtracted when we figure out total equity, right? So withdrawals goes up, which decreases equity, and assets go down because cash decreased. And then they give us our final balances, okay? See those? Does the accounting equation hold after analyzing all these transactions? Yep, it does, okay? Any questions on that? How'd you guys do on that? I want to make sure you know how to do that, okay? If you're like thinking, I don't know what he just did, or you were just getting tons of them wrong, okay, that's all right. Recognize it now, though, and let's work on that together. Shoot me an email for you folks at home. Come into tutoring, office hours, or just look through it again and try it again. The best way to assess, and you're going to hear me over and over say this, you're going to hear me say this a lot during the semester. The best way that you can assess if you know this is to get a blank piece of paper out, look at the question, and see if you can do it. And you're like, well, what else would you do? A lot of students get it all wrong, and then they look through the answer and they go, okay, now, yeah, I understand it now. I can see what he did. Well, just looking at what I did and understanding what I did, that doesn't mean you can do it. Does that make sense? Right? I can watch Tiger Woods play golf and I can understand what he's doing. But does that mean I can go out and hit the ball like Tiger Woods? No. Okay? So, don't just look over it and go, does this make sense? No. Get a blank piece of paper out. Set it aside. If you got a lot of them wrong, set it aside. Maybe tonight, get a blank piece of paper out. Don't look at the answer and see if you can do it. Cool? All right. Okay, what I want to do now, what was the, I think I assigned exercise 1-8. And was that the last one?
Yeah.
Okay. I'm going to hold off on that for now. Might go through that at the end of the lecture, but I want to make sure I get through the lecture. Okay? So if we don't go over exercise 1-8 today, we will go over it next lecture. Cool? I want to talk about a very important subject today. And that is going to be the financial statements. Okay? I want to start introducing the 4 financial statements. Okay? Now, do you remember when I said during those first lectures that financial accounting is primarily satisfying the needs of external users? We provide information to external users so they can make better decisions, right? Well, these 4 financial statements, to go to the screen, these 4 financial statements are primarily what we prepare as far as information for those external users. The income statement, the statement of owner's equity, the balance sheet, and the statement of cash flows. Okay? Now, I want to point out something that I don't think the book makes as big a point that they should. This is the order that you prepare these in. Okay? So you have to prepare the income statement first, then the statement of equity, then the balance sheet, and then the statement of cash flows. One of the things that I guarantee you will have to do on the test is to prepare the first 3 financial statements. And here's how I know a student doesn't know what they're doing. When I tell them, okay, prepare those 3 financial statements, and they start on the balance sheet. No, you can't do that. You have to do the income statement, and when you're done with the income statement, you do the statement of equity, or owner's equity, and then you do the balance sheet. And the reason is one flows into the next, which flows into the next. And we'll see that. Okay? Let's take a look at the income statement first. Now, the income statement, sometimes it's called the P&L, which stands for profit and loss. This one is intuitive. The income statement is very intuitive. As a matter of fact, we use a lot of terminology in our lives that kind of go back to this. You ever hear somebody say, hey, what's the bottom line here? What's the bottom line? Right? Well, they're kind of referring to an income statement. The income statement, as in this case, it shows the revenues for a company, less their expenses, and hopefully that equals that a positive number, and that would be a net income, right? Revenues minus expenses equals a net income. This example that you're looking on the screen, it's a very simplified example, isn't it? There was one revenue account, one expense account. Now, normally there's a number of revenue accounts, and you want to list those out and then do a total revenue. Normally there's a number of expense accounts. You want to list those out, do a total expense. Okay? But this shows the revenues minus the expenses and then the resulting net income in this case. Now, can you ever have your expenses for a period of time be greater than your revenues? Yes. What's that called? Not a net income, but a net loss. Net loss, right? Okay? Now, okay, I want to point out something that's really important on this income statement. See up here in purple, you've got the name of the company, the name of the statement, and then it's dated for the month ended December 31, 2010. Okay? When you prepare a financial statement, I'm always going to ask you to prepare it in good form or in proper form. So don't just give me Don't just give me this section here. No, I want you to prepare it in good form. Give me the name of the company, the name of the statement, and I want you to date it properly. Otherwise, it's kind of worthless information. What if you just got this information, the white part with the numbers? What does that mean, right? You ever find a phone number that you wrote on a Post-it note and you just wrote the phone number and there's no name next to it and you're going, this must have been important, but I sure wish I would have wrote the name next to it, right? Again, we are providing information for external users. You list the name of the company, the name of the statement, and you date it, and you want to date it properly. Okay? Coming off the screen for a second. Jacob? Jake?
Yeah.
The Jakester? Okay. Jake?
Preferably not.
Preferably not. You have a cell phone?
Yes.
Okay. Okay, if I asked you, what is your cell phone expense? And you told me $150. That is not real meaningful, is it? Because do you pay $150 a month for it? Do you pay $150 a quarter for it? If so, that's a cheap, that's an inexpensive one, right? Or do you pay $150 a week for it, right?
That's expensive.
That'd be really expensive, right? No, when you ask about expenses, you can't just say, my expense is this. No, you have to say, my expense for the month is this. Okay? Or if I had a student who was working full time, Allie, if you had a full-time job, and I say, what do you earn on your job? And you say, I earn $12,000. Well, I don't really know what that means, do I? Is that $12,000 a year? If so, that's not a real high-paying job, is it? Is it $12,000 a quarter? If so, not bad. Is it $12,000 a month? Do you earn $12,000 a month, Allie? No. Is it $12,000 a day? Are you LeBron James? It's $12,000 a minute, right? You see what I'm saying? When you talk about expenses or revenues, you can't just say, here's the amount. You have to say for the month ended, or for the year ended, or for the quarter ended, or for the week ended. Does that make sense? So going back to the statement, let's say that a student just dated it by putting December 31st, 2010. I would lovingly take a point off on their test. They need to put for the month ended December 31, 2010. Do you understand that? Okay, that's the income statement or the profit and loss. People know that one. Any questions? Let's go to the next one. The next one is what? What's the next one we prepare? Statement of equity. And this is the one that students and people don't really know. The statement of equity shows the changes in owner's equity for the period of time. This one is also prepared in good form, isn't it? The name of the company, the name of the statement, and it's dated properly. Once again, for the statement of equity, for the month ended December 31, 2010. You want to date it the same way as the income statement. And this is real easy to see because you can see the beginning of the month balance. Where's my pointer? You can see the beginning of the month balance right here, and you can see the ending of the month balance right here, right? Now, one of the reasons I gave you that quiz in regards to how equity changes is because it comes in useful when we do the statement of equity, right? We can see that equity decreased with withdrawals, didn't it? Withdrawals caused equity to decrease. Investments of owners by $20,000 caused it to increase, right? Withdrawals caused it to decrease. Investment by owners caused it to increase. Now you might say, now wait a minute, Krug, I remember that quiz. You told us revenues cause equity to increase and expenses cause it to decrease, right? Wasn't that the quiz? And then you have something here causing it to increase that wasn't an answer on the quiz. Net income. Okay? Okay, I didn't lie to you. You weren't wrong. Here's the scoop. Yes, all revenues cause equity to increase. Yes, all revenues cause equity to increase. And yes, all expenses cause equity to decrease, just like your quiz said. However, on the financial statements, we don't take the revenues over and add them and take the expenses over and subtract them. We just figure out the net number and take it over. Are you with me? So looking back at this statement, we just take that net number. We don't add 3,000 revenue and subtract 800 expense. We just take the net number over to the statement of equity. In this case, $2,200. And since it's a net income, it's added. If it was a net loss, we would subtract it, right? Does that make sense? Now another thing here. I want to point out, what is the beginning balance of capital at December 1, 2010? It's 0, isn't it? I don't want you to think that the normal beginning balance on your statement of equity is 0. The only reason it's 0 in this instance is because this is the first month of business. You understand? So it was 0. At the beginning of the month, it's 0. It's like if you just opened up a checking account. Yes, your first checking statement, the beginning balance would be 0, right? But then if you had a checking statement, December's ending balance of cash in your checking account becomes January's beginning balance, right? And it's probably not going to be 0, is it? Hopefully not. So looking back at this statement of equity, the beginning balance is 0 only because this is the first month of business. The ending balance of capital is 21.7. Do you see how when we do a statement of equity next month for the month ended December 31, 2011, the beginning balance will be 21,700. You understand that? Okay. So don't be thinking the beginning balance is always 0. All right. These are the first two statements. Income statement, statement of equity. Do you see why we have to prepare the income statement first? Because the net income flows into the statement of equity. Any questions on those?
When the owner invests like $20,000 and then he wants to pay himself back through the company, would that be considered the company's expenses? Or
That's a great question.
it wouldn't be a withdrawal, would it?
That's a great question. Let's go back to the screen. And in that, let's just say in this instance, the owner invested $20,000 in the business, but then the owner also withdrew $500. Okay? When an owner's withdrawals are not considered expenses.
Right.
Okay? That withdrawals is not an expense. Okay? So the owner compensates themselves with withdrawals.
And that's how they pay themselves back?
Yes.
Okay.
Now, again, I'm telling you the very basics right now. As we get a little further into accounting education, I'll tell you some exceptions, but I don't like to go down those roads now. Okay? For your purposes, yes, when a owner wants to compensate themselves, they do that through withdrawals, and a withdrawal is not an expense, and that's why it doesn't show up on the income statement.
Is it an option for the owner to pay themselves through salary expense like they do the rest of their employees?
That was what I was trying to
Okay.
avoid, and then Marlon asked me. So thanks a lot, man. Okay, for your purposes, I want to say no. Okay? For your purposes, I want to say no. They need. They're going to. I want at this level in your accounting education, when the owner has money, it's a withdrawal. Now, down the road, you can probably tell. Yes, there are some instances. There are some. Okay, but for your purposes, can we just say the owner compensates themselves properly through withdrawals, not through salary expense? Okay, make sense? Good questions. When you ask these questions, I can tell you're thinking about these things. That's good. All right. We did the income statement. We did the statement of owner's equity. What's the next one we prepare? The balance sheet. Now, what is the ending balance of capital on the statement of owner's equity? What is it? 21.7, right? And there it is right there, right? Where's my pointer? There's that ending balance of capital. That flowed from the statement of equity, didn't it? So do you see why we have to do the balance sheet after the statement of equity, right? Well, the balance sheet is called the balance sheet because it shows that the accounting equation is in balance. assets truly do equal liabilities plus owner's equity. And we can see that. What are assets? 26.9. What's your total liabilities and equity? 26.9. It gives the reader a really warm fuzzy to see that those numbers are the same and that things balance. All right? Now, make sure when you do your balance sheet, you need to put this total, but I also want you to label them. Okay? Don't just have 26.9 down there on the bottom line. I want you to say total assets, 26.9. And then on the other side, total liabilities and equity, 26.9. You with me? But you can see we list out our assets and the ending balances. Okay? The ending balance. Remember when we did the transaction analysis, exercise 111? Remember how we had the ending balances? At the end of that exercise, we had the ending balances at the very bottom of that page. That's what you could use to prepare financial statements. Okay? Let me see what else here. Oh, this one is prepared in proper form. What do I mean by proper form? I mean that it has the name of the company, it has the name of the statement, and it's dated properly. Now, this one is dated a little bit different, isn't it? It doesn't say for the month ended. It just says December 31st, 2010. And that's proper. If the student who prepared this would have said for the month ended December 31, 2010 on the test, I would lovingly have taken off a point. And here's why. To come off the screen for a second. When we talk about assets or liabilities, we're talking about a point in time. It's like a snapshot. For example, nobody here works at a bank, right? Anybody here have a checking account? Okay. Well, Jake, if you called the bank and said, how much money do I have in my checking account? They would say, as of today, right now, you have $812.04. You wish, okay? But they wouldn't say, for the last month, this is what you've had, because it goes up and down, doesn't it? Right? Anybody here have a car loan? Anybody? Marlon? Okay. Marlon, if you called up the bank and said, how much is my auto loan payable? They would say, as of right now, it is $2,216, right? They wouldn't say for the last month, this is what it's been. No, it changes every day, right? Interest builds up, you make payments, it's changing all the time. So when you talk about assets or liabilities or equity, it's at a point in time. Make sense? So the only way to date a balance sheet is either say December 31, 2010 or as of December 31, 2010. But don't be saying for the year ended or for the month ended, because it wasn't those same amounts during that whole period of time. Make sense? I know that sounds, gosh, this guy's picky. Well, no, not picky. Maybe I am picky. But I want you to learn it. It's just as easy to learn it the right way, correct? And remember, we're preparing this for other people to look at. We want it to make sense to them, or else it won't help them make better decisions, correct? So the income statement, the statement of equity are going to be dated the same. In this case, it was for the month ended December 31, 2010. The balance sheet, boom, at December 31, 2010. Cool? Anything else? Any other questions looking at this statement? Okay? We'll get some practice in preparing those. Now, the fourth financial statement that we're going to prepare, the fourth financial statement that financial accountants prepare is the cash flow statement, or the statement of cash flows. Now, let's look at this and appreciate its beauty, but you, as a student in this class, will not prepare this financial statement. I want you to know it's the fourth financial statement, but you do not prepare the statement of cash flows in this class. It's beyond the scope of this class. Does anybody know that they're going to be taking accounting 2 sometime? Well, we will learn it then, okay? It's a little bit more difficult. It basically just shows cash flows. Don't worry about it now. Don't worry about it now. The only question I might ask you on a test is, what's that fourth financial statement? It's the statement of cash flows. The ones that you'll prepare, and you'll prepare them in this order: the income statement, statement of owner's equity, the balance sheet. Boom, boom, boom. They flow right into each other. Cool? Questions? All right. I can already tell we're not going to have time to go through that exercise 1-8. Was that kind of tough? Exercise 1-8? Wasn't too bad? It wasn't as tough as exercise 111? Okay. Well, we'll go through exercise 1-8 next time. So if you haven't done it, I'm going to give you a little bit of a hint. Okay? And this is for you folks at home too. Okay? We know and it is exercise 1-8 that we didn't go through, right? Okay. We know that assets equals liabilities plus owner's equity. We know that, right? And we also know that that has to be true at the beginning of the period and also at the end of the period, right? And then whatever change occurs, change being the triangle delta sign, that has to also be the case, right? So what you can do is, and I'm especially talking about B and C on exercise 1-8, is start putting if they give you beginning numbers, put those in here, figure out the other one. If they give you ending numbers, put those here. If they give you changes, put those there. It's kind of like a puzzle because it has to work vertically and it has to work horizontally. Does that make sense? So if you haven't done exercise 1-8, you might use that format. Okay? All right, let's talk about what your homework is going to be. Okay, what I want you to do for next time is I want you to do quick study 112. And I guarantee you will have a test question like that. That is giving you accounts and asking you what financial statements they go on. That's very, very, very important to be able to do. Okay? So quick study 112. I'm not done. Not even near done. I want you to do... I'm not going to sign that one yet. The other one I will sign is exercise 114, 115, and 116. Now, exercise 114, 115, and 116 are you preparing an income statement, a statement of equity, and a balance sheet. Okay? And let me see if there is anything. It seemed like there was a note I wanted to make on that. Yes, there is. Okay? Let's take a look at this real quick. This is exercise 114. Whoa, you getting seasick there? Okay. See this owner investment 7,400? Okay. Let's just read through this. On October 1st, she organized Real Solutions. And then you're going to prepare financial statements as of October 31st. You with me? Okay, see this owner investment 74,000? See that? Let's just assume that she made that on October the 2nd. Are you with me? Because a lot of times people are like, well, I don't know. Are you telling me that that's the beginning balance of capital? Or is that an investment by the owner during the month or what? Okay, well, let's just say she made that on October the 2nd of 2000 and, did they give us a year? Okay. Let's just say let's just say she made it on October 2nd. So what would be the beginning balance of capital on October 1st? 0. Are you with me? Okay. That's the one thing I wanted to clarify there. The other thing that you might do, we have about 20 seconds left, is when you go through these, the first thing that I would recommend that you do is go through each one of these and write down what financial statement it goes on. And then as you put it on that financial statement, circle it or put a check mark by it. Otherwise, you're going to forget to put an account on a financial statement. You with me? Okay, so I want to make sure, here's the total homework assignment right here. I tell you what I'll go ahead and do. I'll go ahead and put exercise 1.8 down again to remind us to do it if we haven't, and to remind me to go over it next time. All right? You guys are doing great. We'll see you next time. Bye-bye.